Hey everybody, it is Greg Gossett from Gossett Trading and Mentoring. Hey, how you doing? I hope you are having a nice weekend. Happy 4th of July. Today is Saturday, July 4th, 2026. So happy birthday to the United States. And I hope you are having a nice weekend. I hope you had a good trading week last week. Um, I was very fortunate to have a very good week after a few weeks of not so great results, but last week was fantastic. And so just kind of goes to show you that there are sometimes you have some weeks where you struggle, but I've been doing this for over 30 years, and I do know that as long as I keep repeating my process, things usually work out, and they did. So I hope the same for you. And again, wish you uh, uh, happy weekend. And I appreciate you coming to my weekend review podcast. I hope you are going to find it helpful. I think I have some good things to share with you. The format for the podcast today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back and we're going to take a look at all the trades and the positions that I have from last week. We're going to talk about when I entered the trade, why I entered the trade, what the signal was, what the confluences were, how I'm going to position size based upon the current market volatility, how I'm going to place my emergency stop, how I'm going to place my end of bar stop, how I'm going to take partial profits if the market moves in the direction that I want it to, and then ultimately how I am going to exit the trade if it gets to overbought levels, or how I'm going to exit the trade if it goes below my stop. One of the two. Something's going to happen for sure. So I hope it's going to be helpful for you to get an idea of, first, how I enter a trade, why I enter a trade, what the signals were, and then really more importantly, how I manage the trade going forward. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading, in my opinion, is the ability to create a plan and to follow the plan. There's a lot of good plans out there, a lot of them. But the difficult part is not finding the plan or creating the plan, it's following the plan and not letting emotions get in there and mess up your plan, get you off track. So it's very important. I always like to teach trader psychology. And so I hope that it's helpful for you and that you'll pick something up um, from the trading psychology section that will resonate with you and will improve your trading. After that, last night, I did go down through my master watch list, every symbol, every stock, one by one, and I have identified some potential trades that I'm looking to take next week. Now, these trades are not where they need to be yet, but they are getting close to some significant support levels. And what I need to do is I need to see if these levels will be tested and rejected. And if they are tested and rejected, then that improves the odds of when I enter the trade of having a profitable trade. Doesn't guarantee them, obviously, but it does improve the odds. I like to see multiple levels, indicators rejected to show that, okay, the market tested it, nobody wants to sell down there, and therefore, again, improving the odds. So I went through one by one. I have found some really good ones, really, and I'll share with those with you, give you an idea of how I look at things, how I look at potential entries. Then, of course, we'll share with you, where my stops are going to be and so forth. So anyway, if there's anything in this podcast that you find helpful or valuable today, I would really appreciate it if you could hit the thumbs up button. It really does help the channel, lets YouTube know that there's some valuable content so they can get it out to more traders. And with that, let's get the U.S. legal disclaimer running and get that out of the way, and then we'll get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. So let's start with Walmart. I did enter Walmart on Thursday here at 111.81. Now, a lot of confluences, a lot of signals happened on this entry, lots of them. Now, does that improve my chances? 100% it does. But is it guaranteed to be a profitable trade? Absolutely not. But there's multiple things here, but let's first go over this green box. This green box is an order block. I don't know if you're familiar with order blocks, but I use them in probably 90% of my trades. They're one of the strongest technical indicators that I have come across, and like I said, I use them all the time. So I like to call order blocks smart money areas. I know they're called order blocks, but really I look at them as smart money areas, and I'll explain why. So this order block was formed in the past. Let's go all the way back in the past and see why this was created. So the order block here starts on January 8th of 2026. So this is a long time ago that this order block was formed, but these things tend to hold memory. So let's first talk about what an order block is. An order block, in order to have an order block, we need the following pattern. We need, starting with this swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. And you can see this is the swing low because the bar to the left has a higher low, the bar to the right has a higher low as well. So that is a swing low. Now, after the swing low, we need to have a swing high. A swing high is just the opposite. It has to have a lower high to the left and a lower high to the right. So here's our swing low, followed by our swing high. Now, after this happens, we need to have another swing low that is lower than the first swing low, and you can see this would qualify. This is certainly a swing low that has a higher swing low to the left and a higher swing low to the right. So let's review. Swing low, swing high, lower swing low. Okay, we got all of those. Now, after you have those in place, the important level that we need to concentrate on is that first swing high. Remember, swing low, swing high, lower swing low. We need to refer back to this swing high. And after this second lower swing low is in place, if in the future the price moves up above that swing high, now you have changed market structure to the upside, and that is important. So swing low, swing high, lower swing low, market structure change. Now, as soon as the market structure changes, now we can define our order block. And our order block is the lowest closing bar prior to market structure change. And you can see after it changed market structure here, it really did take off. But so as soon as it went above that swing high, now it defined this order block. So we bring this order block into the future, and now I am waiting for the price to come back in this area. So if we look at the swing low here, and then we look at what the price did, it moved up dramatically. So the swing low's down here in the $110 range. And when Walmart got up to the $130 range, is it fair to say I can look back at this order block area and say that smart money was buying here? And of course, you know, in hindsight, when the market's up here and the order block was formed back down here, clearly smart money was buying here. So what I'm waiting for is I'm waiting for the price to come back down into that smart money area. Now, if it does come down there, does that mean it will be smart money again? It was smart money over here, but does it mean it's going to be smart money over here? Not necessarily. It was at the time, but in the future, things can change. But in my experience, more times than not, an area that was previously smart money is more often than not smart money again in the future. But not always, but more times than not. So I'm bringing this smart money area all the way into the future. And you can see it took a long time for the price to come back down into the smart money area. And it did here back in June, and that's exactly where it bounced from. But of course, Walmart has sold off significantly since then. But now we are in that area again. So to enter into an order block, there are multiple ways that you can do it. You can get in with a rejection of the high of the order block. So in other words, the price comes at the top of the order block, comes into the order block, and then closes back above. That is one way to do it. And you can see that's exactly what happened here on this bar. On the second, it rejected the high of the order block, and it did take off nicely. Alternatively, you can get in with a rejection of the bottom of the order block, which is what happened on Thursday. On Wednesday, we closed below the order block, and then we closed back in it. That by itself is a legitimate entry. Now, there are other ways to get into a trade in the order block without a rejection of the high of the order block or the low of the order block, and that would be a rejection of a major moving average, like we had here on Thursday. We had a rejection of the 300-day moving average. You could use a 200-day moving average. You could use a 250-day moving average. You could use a 30 RSI, or sometimes I put my own custom levels in. But on this particular trade on Thursday, there were a lot of confluences of signals. Right off the bat, there was a rejection of the bottom of the order block. Wednesday, it closed below the order block. Thursday, it closed inside the order block. That's one. Again, we rejected the 300-day moving average, which is the orange line. On Wednesday, we closed below it. On Thursday, we closed above it. That is a close under, close over the 300-day moving average. That is a legitimate deep dip buy signal. If you reject the 200, the 250, the 300, that is a legitimate signal just by itself, but it's a better signal in my opinion because it happened inside the order block. Also with deep dip buys, a reading of a close under 30 and a close over 30 RSI is also a legitimate deep dip buy signal. Well, these all happened on Thursday. Wednesday, we closed below the 30 RSI. Thursday, we closed above 30 RSI. By itself, that's legitimate, but it's a stronger signal, in my opinion, because it happened at the same time that we closed below the order block, above the order block. Wednesday, we closed below the 300. Thursday, we closed above the 300. Okay, so what are the total signals here? Close under 30, close over 30, close under 300 moving average, close over the 300 moving average, and a rejection of the bottom of the order block. Great signal, great confluences of signals. And, from over 30 years of trading, if I were to take this trade 100 times, just from experience, I would probably be profitable 70 times out of 100. But there's the 30 times out of 100 where I'm not going to be profitable, and this may be one of them. I just don't know. But if I have a situation where I have about a 70% win rate with a good risk to reward, I'm going to take it. And so that's exactly what I did. So I did enter Walmart on Thursday at 111.81 because a rejection of the bottom of the order block, a rejection of the 300-day moving average, a rejection of the 30 RSI. So first thing, when I enter this trade, I have to think to myself, and I have to decide, obviously, how many shares am I going to buy? And it's probably the most important decision you're going to make with a trade, because you can't buy too many shares because you're not guaranteed that it's going to be profitable. But you want to buy enough shares that if you're right, it can make a difference, a positive difference. So the formula that I use and have used for many, many, many years, I'll share with you now. It's very simple. It has to do with how much money do I have in my trading account and what is the current volatility of the market. So let's just say I have $100,000. 1% of $100,000 is $1,000. That is going to be my maximum allowed loss on this trade. 1%. Losing 1% is not fun, but it's not the end of the world. You can recover from that. So first thing I do is I take 1% of my total trading capital. 1% of 100,000, $1,000 my maximum loss. If you had a $200,000 account, 1% would be 2,000. If you had $1,000,000 trading account, 1% would be 10,000. Okay, so in this example, 1% of a $100,000 trading account is $1,000. This is the maximum I'm allowed to lose on this trade. Second thing I need to look at is what is the value of the 2 ATR. This measures volatility. If volatility is higher, this number is going to be higher. If it's lower, this number is going to be lower. So I take my maximum allowed loss, in this case $1,000, divided by the value of the 2 ATR. This is going to tell me exactly how many shares to buy based upon the current market volatility. And this is telling me to buy 175.7. So I'll just round up to 176 shares. So the signal was a rejection of the bottom of the order block, rejection of the 30 RSI, rejection of the 300-day moving average. I position size based upon my account size value and the volatility, and boom, presto, it tells me to buy 176 shares. Boom. So I buy. The very next thing I need to do is I need to refer back to the value of the 2 ATR that I just used in that calculation. Okay. I take my entry price minus the value of the 2 ATR, and I place my emergency stop down here. This is my emergency stop. If I have 176 shares and they move down $5.69, we just did the math, how much would I lose? $1,000, or in other words, 1% of my account. Now, I always use two stops. I use the emergency stop here, which if it hits, I lose 1% of my account. But the good news is that I only hit this emergency stop about 5% of the time. The other 95% of the time, if I have a losing trade, it is not going to be because of my emergency stop. It's going to be because my end of bar stop was triggered. And the end of bar stop is always going to be much closer to my entry than the emergency stop. So 95% of the time, if I have a loss, it will be less than 1%. So we need to look here, how many, what is my end of bar stop? We know the emergency stop is the value of 2 ATRs below my entry. Where's my end of bar stop? Well, I have multiple choices here because I had multiple signals. Under 30, over 30, therefore, if I have a close below the 30, I could get out. But whenever I reject a major moving average, which is the 300-day moving average, I prefer to use the 300-day moving average at this point, because that's one of the main reasons I took the trade. So going forward on this trade, if I close below the 300-day moving average, that will be my signal to exit the trade. But it's closing price. If on Monday this goes below the 300 intraday, but closes above the 300 by the end of the day, I would still keep the position, because the closing price, in my opinion, is the most important, because at the end of the day, really the large financial institutions come in and kind of move everything to where they feel like it's the valid price. They're dealing with, they have very smart people, they have the best information, they have the best technology, They're dealing with the most money, right? And so at the end of the day, that closing price, again, in my opinion, is the most valid price. What happens during the day really is kind of nonsense to me. I want to key off the closing price. So my end of bar stop on this particular trade will be a close below the 300-day moving average. And the 300-day moving average at the moment right now is 110.17. All right. So we know why I entered this trade. Confluence of signals. Close under, close over the order block, close under, close over the 300-day moving average, close under, close back over the 30 RSI. So I entered here on Thursday at 111.81. I position size based upon the account value and the current market volatility. I know where my emergency stop is. 2 ATRs below. If it gets there, I lose 1% of my account, or in this example, $1,000. My end of bar stop, which is much closer to my entry, is a close below the 300-day moving average. The next thing I do, once I have all of those things set, I need to take my entry price plus the value of the 1.5 ATR, and I need to place that above me. Right now, the 1.5 ATR is $4.27. So I simply take my entry price plus 427 and I place this orange line above the entry, $4.27. This is my trailing stop mode. So in trading, if you get into a trade and it starts to move a certain distance from your entry, for me, it's 1.5 ATRs. Once it starts to move up nicely, you want to start tightening your stops. You don't want to do it too soon. You need to give it some room to breathe. But for me, if it moves 1.5 ATRs from my entry, then I say, aha, okay. Now it has moved a significant distance from my entry. Now I want to tighten up my stops. Now I don't actually move my stops up. But what I do is if the price gets to my trailing stop mode, 1.5 ATRs above my entry, now I go into what is called trailing stop mode. Trailing stop mode just means is if when I enter the trade, if it gets to that 1.5 ATR threshold, it puts me in trailing stop mode. It doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I'm going to exit half of my position. And by exiting half of my position, it has the same effect of moving all my stops up. I don't physically move them up, but I take half off, and that does the same thing. So I hope that makes sense. And, because I don't want to buy here, have it go all the way up here and not do anything, because that's a nice move up, and then come all the way back down and go, man, I had this great trade and I didn't do anything with it and I was in the money. Well, that's why trailing stop works so well. I get into trailing stop, I don't do anything. I'm just in trailing stop mode. And then in the future, if I have a close below previous bar's low, I exit half. So if I exit half and it goes down, I'm really glad that I exited half. If I exit half, but it continues up, it's okay. I still have half. So selling half, in my opinion, is one of the only win-win situations in trading. And there's not a lot of them. And so it's worked out well for me going in trailing stop mode. So everything I have talked about so far as the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves. In other words, if the market goes against me, I have to take action. If the market hits my emergency stop, I have to get out. If the market closes below my end of bar stop, I have to get out. If I go into trailing stop mode and then have a close below previous bar's low, I have to get out. These are all defensive moves. The market went against me. I had to make a defensive move. But I don't just want to play defense, right? Just like in sports, a good sports team has to play offense and defense. Well, I want to play offense in my trading as well. And so let me show you how I do that. It's very simple. This works very well for me. But what I do is if the market that I'm trading or that I have a position in If it moves a certain distance from the previous day's close, I will sell a portion of my position into strength offensively. So I entered Walmart on Thursday. Let me show you exactly how I'm going to have this set up for Monday. I simply take the closing price. Right now, the closing price is 111.84, and I refer to now the value of the 0.45 ATR. Today, the 0.45 ATR is $1.28. It changes every day, so I have to redo this every day. But for today, for Monday, the closing price 111.84 plus the value of the 0.45 ATR plus 1.28. My first profit target for Monday is 113.12. So let me just draw the line up here. 113.12. There is my first profit target for Monday. Now the question is, how many shares am I going to sell if it gets to there? It's very simple. 10% of however many shares I go into the day with. If I go into the day with 100 shares, I'm going to sell 10 at this first profit target. Now, I don't just set one profit target. I set 3 profit targets. First profit target, closing price plus the value of the 0.45 ATR. We just did that math. It's 113.12. There's my first profit target. To get my second profit, I simply take the value of my first profit target, 113.12, plus $1.28. My second profit target for Monday only is 114.40. So I'll put that there. There's my second profit target. To get my third profit target, I simply take the second profit target, 114.40, again, plus the value of the 0.45 ATR, plus 1.28. My third profit target for Monday is 115.68. And there you go. Those are my 3 profit targets for Monday. Again, if I hit any of these profit targets, 10% of my account. So if I go into the day with 100 shares and I hit one profit target, I sell 10 shares. If I go into the day and the market moves up very nice and I hit 2 profit targets, how many shares have I sold? 20. 10 at the first, 10 at the second. If I have a fantastic day and it moves way, way up, how many am I going to sell? 30, right? 10 at the first, 10 at the second, 10 at the third. Now, if the market goes down, then I don't hit any profit targets. And then I have to if I'm still in the trade, I have to recalculate for the next day. But I'm a big fan of these partial profits. A lot of times stocks will move up. I'll take profits. I lock in. The market can't take that away from me. I reduce my position size, which reduces the stress of the overall trade. And so to me, it's a really, really important part of my trading. And it just makes sense, right? Play offense and defense. Some people are just focused on offense. I don't think, I think that's kind of one-sided. Some people just focus on defense. It's fine. But again, I think it's one-sided. But I think there needs to be a balance of offense and defense. And this is why I take the profit targets this way. So, all right. So I kind of gave you the basics of taking profit targets, setting the stops, and so forth. So again, this trade on Thursday entered at 111.81. Confluence of signals, close under 30, close over 30 RSI, close under 300, close over the 300, and also close under, close back in the order block, rejection of the order block. I position size entered at 111.81. I placed my emergency stop 2 ATRs below. If it gets there, I lose 1% of my account. There's only about a 5% chance that will happen. The other 95% of the chance, if I have a loss, will be that it closes below the 300-day moving average. If it moves up, I will continue to take partial profits if the market gives them to me. And then if I get up to trailing stop mode, then I go into trailing stop mode. And once I'm in trailing stop mode, if I have a close below a previous bar's low, I sell half the position. All right. So anyway, this is a break even trade because I just entered it. And let's go on to the next trade. All right, next trade. It's been a very good trade on CRM, which is Salesforce.com. So we don't have an order block involved in this particular trade, but let me bring your attention here to the trade on, or the day of 6/22/26. I've highlighted this bar in blue. So this bar that I've highlighted in blue is called an abandoned baby, a bullish abandoned baby. So what makes it an abandoned baby? Strange name, right? Well, an abandoned baby consists of 3 bars. Bar 1, bar 2, bar 3. Do you notice how the number 2 bar gapped down from the number 1 bar? So here's the number 1 bar. Do you see how the next day we gap down? Well, if you gap down from the previous bar's close to the current bar's open, if you gap down, that's bearish, right? There's bearish sentiment. However, the very next day after gapping down, we gap back up. So that's a very sudden shift in sentiment of gap down bearish to gap up bullish. When this happened, there's a lot going on under the hood. The market sentiment has changed very quickly from bearish to bullish. And like I said, there's a lot going on under the hood there. So when that happens, a gap down followed by a gap up, I highlight the abandoned baby. Now, I did not take the trade on this day. I could have, but I didn't take the trade. Usually when an abandoned baby happens, it tends to go up and then pulls back before it heads back up. And that's exactly what happened. So the abandoned baby happened here. I saw it. What I was looking for was a pullback. There's many different ways you can use the abandoned baby, but in this particular case, I was waiting for rejection of the high of the abandoned baby, which didn't happen. However, on the day that I took the entry, it did come back into the body of the bullish abandoned baby, which to me is interesting because after the abandoned baby happens, it is a support, the entire range of the abandoned baby is a possible entry for me. However, I did take the trade here on the 25th. Why? Well, the abandoned baby happened. We pulled back. We rejected the third ATR channel. This is the gray line here. This is the third Keltner channel. 92% of prices when they come down to this negative third ATR channel and reject, that's usually the bottom. Well, in other words, it stops going down, moves sideways, or moves up. So that was part of the thinking of why I took the trade. The other part of the thinking was we basically tested the 30 RSI again. So I had a rejection of the negative third Keltner channel, basically a test of the 30 RSI, and it happened inside of this bullish uh, uh, inside of the bullish abandoned baby. All right. So when uh, when I took this trade, I had to decide how am I going to manage this trade? What are my stops going to be? And when I have a bullish abandoned baby, I sometimes I use a 2 ATR stop loss, a 4 ATR profit target. But what I decided to do was use a close below a 30 RSI because the day that I took the trade, it basically bounced at the 30. So the next day, had it closed below the 30, I would have just gotten out of the trade. But luckily, it did not. So I entered again with a rejection of the negative third Keltner channel, a retest of the 30 RSI that all happened within the body of the bullish abandoned baby. I entered the trade here at $150.10. I placed my emergency stop as always 2 ATRs below. I placed my trailing stop level 1.5 ATRs above, and the next day, thankfully, it moved dramatically in my direction. So once it moved in my direction here, obviously I hit multiple profit targets on this strength, reducing my position size right away, which is nice. I lock in profits, reduce my position size. Next day, I did get a profit target at the top of the day before it reversed. Next day was down. I did not hit any profit targets whatsoever. Wednesday, big move up where I hit multiple profit targets into that strength. In addition, on this day, it got to my trailing stop mode, which is an important level. Now, it doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I'm going to get out of half. Well, next day, it certainly did not close below the previous bar's low, or it certainly did not close below this previous bar's low here. In fact, it went up again, and I took more profits, intraday profits, into that strength. I did hit one profit target. So this trade is doing very, very well, thankfully. Grateful for that. It is up 9.64%. And so moving forward, I'm in trailing stop mode at the moment. If it closes below previous bar's low, I have to sell half. If it continues to move up, I will just continue to take profits in 0.45 ATR profits. Now, it's a 50.04 RSI. If it gets into the 65 RSI level, then I have other rules that will come into play that allow me to get out at the top without having to write it all back down. But really good example of a confluence of signals of a bullish abandoned baby, rejection of the negative third ATR channel in the baby, and another recheck test of the 30 RSI. And it moved up very nicely. So the remaining shares that I have on CRM up 9.64%. Microsoft, all right. Microsoft has been a very nice trade so far. I did enter Microsoft on the 26th of June here at, what is that number? Oh yeah, 373 even. Okay, you can see we have a bullish order block, the green box, from the past. On the day that I took it, a lot of confluences of signals. For one, did we reject the bottom of the order block? We certainly did, because the previous day we were below it, and then on the day that I entered the trade, we closed back in it. So that's a rejection of the bottom of the order block. In addition to that, the previous day was a close under the 30 RSI. On the day that I entered, it was a close over the 30 RSI. That's a deep dip buy. So we have a close under, close over the 30 RSI. At the same time, we have a close under, close back in the order block. In addition to that, we have what is called a V2. A V2 consists of 3 bars. Bar 1, bar 2, bar 3. In this case, bar 2 goes under the low of bar 1's low, and bar 3 closes above the close of bar 1's close. So it forms this V. Bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. All right. So that is why I entered the trade. The confluence of signals. Close under 30, close over 30, rejection at the bottom of the order block, and a V2. So now we have to decide, or I have to decide, where is going to be my end of bar stop. Multiple possibilities for me, but what I am going to use is simply, just to make it simple, one of the reasons I got into the trade was because it closed under 30, closed over 30. So in the future now, if it closes back under 30, that will be my stop. Okay, so I entered here 373 even. As always, I have my 2 ATR emergency stop. If it gets there, I lose 1%. My end of bar stops, it closed below the 30 RSI. I placed my 1.5 ATR trailing stop level above. The next day did go up, but reversed back down. Next day we headed up. Next day was a nice big up day where I did hit multiple profit targets. And then on Thursday, again on the strength, I sold into that strength. You can see I have my 1.5 ATR trailing stop level above here. Have not reached that yet, but if we have, any kind of up day on Monday, very likely will hit that. Now I'm in trailing stop mode. So good example again of confluences. Close under 30, close over 30, rejection of the bottom of the order block plus a V2. By the way, if you want to learn more about V1s or V2s, they're very similar, just different bars. Go to my YouTube channel. I think I have a good video there that explains in detail how I use these. I don't usually use these just by themselves to get into a trade, but if the trade incorporates deep dip buys or order blocks, primary signals, having a V1 or a V2 just helps the quality score of the trade. So anyway, this particular trade's doing well. The remaining shares I have on this trade up 4.46%. Apple. Apple's been a fantastic trade, and I think this is a good teaching moment as well. So I entered Apple here on the 29th of June at $281.61. So you can see the green order block here. All right, this order block is formed back in the past. And you can, after the order block, Apple really took off, and we have come back down to that smart money area. But the key is why I entered the trade here. And I entered the trade for one reason is because it rejected the top of the order block. Now, I don't often enter with a rejection of the top of the order block. But in this case, I did, and let me explain why. Because usually if I enter with the rejection of the top of the order block, my stop is going to be a close back below the low of the order block, which is quite a long distance. So it doesn't have a good risk to reward ratio. But let me first let me explain why I entered the top of the order block. So what I saw here is a extension of a megaphone trend line. A megaphone trend line is when you have a swing low and then you have a lower swing low and you connect the first swing low to the second swing low. And after those 2 points connect, the trend line goes down into space, right? Out into time. And usually if you reject the third touch of the megaphone trend line, that's generally a good sign that you may be going back up. And so this bar went right through that third touch of the megaphone trend line, but the next bar went back up. So could I have taken the trade the previous day? Yes, 100% I could, but I decided to take the trade here on this day when it retested the top of the order block and it retested the megaphone trend line and closed back above. So that was my entry. Now, of course, so I entered there at 281.61. I placed my emergency stop as always 2 ATRs below, but the question here is what I'm going to use for my end of bar stop. And there are multiple multiple choices for me to exit. I could use a close below the low of the order block. I could use a close below the 100-day moving average, which is the red line here. But what I decided, I kind of put my own custom level in, and I put the custom level in here at 278.90. And the reason this is my end of bar stop is one, it's closer to my entry, so it's giving me a better risk to reward. And two, I keyed off of this bar here on the 26th. See this big up bar? Well, when you have a large up bar, the halfway point of that up bar tends to have inherent support. So if you have a big up bar, it's normal that the price would come back down, but there it closes below halfway of that big bar less often than it stays above. So in other words, the halfway of that big up bar is my line in the sand. This is my end of bar stop. So I entered here 281.61, but the next day, if we would have closed below 278.90, that would have been it. That would have been all, and I would have gotten out of the trade for a small loss. But again, I put this custom level in because see how close it is to my entry. I always want to get to enter as close to my exit as I possibly can, giving me the best risk to reward ratio. Okay, so I entered here, emergency stop 2 ATRs below as always. End of bar stop closed below 278.90, halfway that big up bar. Placed my 1.5 ATR trailing stop level above. Next day, took off in my direction. Grateful for that. Hit some profit targets on the way up. Next day, up again. Hit some profit targets into that strength. And then Wednesday was massive. Uh, of course, I got to my trailing stop level, so I am now in trailing stop mode, and I hit multiple profit targets on this strength. So this trade has been really, really good in literally in 3 days. It is up about 8.8%. But again, I started with a very good risk to reward ratio. I waited for multiple rejections of key levels. Again, the rejections were the top of the order block, the rejection of the megaphone trend line. I have had a good risk to reward ratio with my end of bar stop there. So great. Now we're at 60.28 on the RSI. If Apple does continue and gets me to a 65 RSI, now I go into a different trailing stop mode that involves the 5 EMA. So if I get to a 65 RSI level, then if I ever close below the 5 EMA, that is the end of the trade. But this has been a fantastic trade. Glad I took the trade, but the signals were there. And the remaining shares I have on this trade up 8.8%. All right, let's go to the Qs. All right, so generally when I talk about order blocks, I'm talking about a green order block, which is a bullish order block. However, I also use the order blocks to the short side, and I shorted the Qs here on the 22nd of June at 737.77. So let me just quickly show you what a bearish order block is. So for a bullish order block, if you remember, we want to swing low, followed by a swing high, followed by a lower swing low, and then a market structure change to the upside, and then I wait for the pull back to the smart money area. Well, for a bearish order block, it's the opposite. We need a swing high, followed by a swing low, followed by a higher swing high, and then price needs to go down below that first swing low and break market structure. So here's the swing high, here's the swing low, here's the higher swing high, and then on this day we broke market structure by taking this out. So as soon as this happens and breaks structure to the downside, I need to identify the highest closing bar prior to the market structure change to the downside, and it's this bar here. The high and the low of this bar I've highlighted in red and move this across. So if I break market structure to the downside, now I need to wait for the market to rally back into this bearish order block, and that's exactly what happened. So I took the trade here on the 22nd of June and shorted the market at 737.77 because on this particular day we had a bearish V1 to the downside. A V1, bar 1, bar 2. Bar 2 has to go above bar 1's high and then close below bar 1's close. That's exactly what happened. But more importantly, it happened at the same time it rejected the bottom of the bearish order block. So I shorted here 737.77. I placed my 2 ATR stop above. As always, my end of bar stop on this particular trade is simply 739.70. Why? Well, it's the bearish V1 that I told you about. If I have a V1 or a V2, the resistance, the support or resistance level, depending if I'm long or short, is based upon halfway of the number 2 bar. Well, the number 2 bar is this down bar. If we closed back above 739.70, that would simply be my exit. And you can see my entry is very close to my end of bar stop. Again, giving me a good risk to reward ratio. So I got short here for those reasons, 737.77. I placed my trailing stop level 1.5 ATRs below because I'm short. The next day, massive down move where I hit multiple profit targets to the downside, short profit targets, and I also got to trailing stop mode in the very next day. Now, because I'm short, trailing stop mode means if I have a close above a previous bar's high, I'm going to exit half the position. Okay, so took multiple profit targets on this day to get to trailing stop mode. The next day continued downwards where I did lock in additional short profits. Next day gapped way up. Actually didn't hit any profit targets whatsoever. I mean, it closed up as well, but it did not close above the previous bar's high, so I didn't do anything. The next day down again, where I took additional profit targets. Next day, we did have our first close above a previous bar's high. So what did I have to do? I had to exit half of the position, again, because I got to trailing stop mode and then we closed above a previous bar's high. So that's the signal. So I locked in a gain of 1.95%, but I still half. Next day took off again like a rocket ship, but did not close above my end of bar stop, which is 739. Next day down, more profit targets. And then, of course, Thursday was a big day down where I hit multiple profit targets to the downside again. So the remaining shares that I have on this short position, doing pretty good, up 3.53%. All right, I think we have one more. Yep, and it's Netflix. So I did enter Netflix here on the 1st of July at 73.79. So why did I take this trade? Well, you can see there's an order block here, but it didn't have anything to do with the order block. Simply the reason I took this trade on Netflix here at 73.79 was the day before we closed under the 30 RSI. The day that I took the trade, we closed above the 30 RSI. In addition to that, we had a V2, bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. That is the reason that I took the trade. I placed my emergency stop 2 ATRs below as always, and my end of bar stop is simply a close back under the 30 RSI. Right now we are at 47.28, so we're well above the 30 RSI. But moving forward, if I do close below the 30 RSI, that will be the end of the trade. I placed my trailing stop level 1.5 ATRs above, and of course on Thursday, excuse me, we had a very nice up day where I sold this particular trade up 5.27%. So there you go, everybody. Those are all the trades that I took. I think it was a good combination of different setups, deep dip buys, 200, 250, 300, 30 RSI rejections, coupled with bullish and bearish order blocks, V1s, V2s, and also abandoned baby. So these are all the different strategies that I use, but can I take the trade based on any one strategy? Yes, I can, but as you see, I like to combine them. It just helps increase the chances of having a positive trade. Okay, so before we get to the potential trades that I'm looking at for next week, let's just talk a little bit about trader psychology. It is the most important skill. This is a really good post. This comes from my friend Steve Burns. You can follow Steve Burns over on X at S Joseph Burns, or you can also follow him at the New Traders, Rich Traders forum on X. Excuse me, on Facebook. But I was looking through the trading psychology post, looking for something that kind of resonated with me to share with you today. And trade small. As soon as I saw this, I knew this is what I wanted to talk about because there are so many advantages to trading small. I always tell other traders, I tell my students that in my experience, at least, and many other traders that I know, make more money with smaller position sizes, which kind of makes sense. Why does it make sense? Because with smaller position sizes, you have less stress. If you have less stress, you're more likely to follow your trading process. And the more likely you are to follow your trading process, the more likely you're going to be profitable. The problem is if you have large position sizes, then the daily fluctuations tend to scare people and get them out of their plan. So let's read this. So this is Steve is sharing this from Richard Dennis. Richard Dennis is a very famous trader. He's a market wizard. So trade small. Because when you are a new trader, that's when you're as bad as you're ever going to be. Learn from your mistakes. Don't be misled by the day. Don't be misled by the day-to-day fluctuations in your equity. Focus on whether what you're doing is right, not on the random nature of any single trade's outcome. So there's a lot to unpack in here, but just from my experience, I mean, Richard Dennis is talking about trading small when you're a new trader, right? Because you're going to be as bad as you're going to be. And that totally makes sense. But even for established, experienced professional traders, I'm also going to say that I see people with smaller position sizing making the most money. So Richard Dennis here is talking about doing it when you are a new trader, but I am talking about always doing it, right? So it just some good advice. I think most traders will make more money with smaller position sizes. It will be less stressful. You're going to follow your process uh, uh, more than you will than with a large position. And it's all about following your process, creating a plan and following that plan. So if you're struggling with your trading, if you're struggling with following your process or the rules of your process, simply trade smaller. I just think you're going to find that it's a more holistic, comfortable, less stress, and more money. It's a pretty good combination, right? So anyway, I hope this was helpful for you. Thank you, Steve Burns. Really appreciate the post. Okay, so let's head over now and take a look at the potential trades that I am looking for next week. Now, I have 6 potential trades that I'm going to go over. I'll explain exactly what I'm looking for. But at this part of the program, I always want to say, here are 6 potential candidates for next week. Is it possible that all 6 of these could potentially trigger on the same day? 100%. Does that mean I would take all 6 trades? And the answer is no. If all 6 of these triggered on Monday, I would have to narrow it down to the best one because I only take 1 trade per day. So how do I do that? Well, I give each particular setup a quality score. For example, if it has 1 signal, I give it a score of 1. If it has 2 signals, I give that one a score of 2. If it has 3 signals, I'll give that one a score of 3. Does it mean I'm always going to take the one with the highest score? No, because everything being equal, yes. But if it, one that has the highest score may not have a good risk to reward ratio. So I have to maybe take back out some points away from that, right? So risk to reward is very important. So I have to contextually look at the entire trade. What's the quality score level? What's the risk to reward ratio? I like to look at higher time frames. If I'm trading the daily time frame, I could look to the weekly time frame to get some clues from there. Maybe there's a signal on the weekly time frame that helps support the entry on the daily time frame. I also look at relative strength is very important to me. Perhaps the entire market is down, but one stock is actually green on that day and has a good quality score, well, the market's telling me that that one is much stronger than the rest of the market because that's up. So this is how I kind of get a magnifying glass out and I go through each one and I look at many different things. And this is how I trade. This is what I teach my students to do. And if I could just take a couple quick minutes and put a little plug in for what I do, I teach people from all over the world. I've taught them for many, many years, and I teach a private one-on-one 20-hour course where I teach my one-on-one student 2 hours a week for 10 weeks. So there's the 20 hours. I teach my students all the trading strategies that I use. I teach them step by step, all the rules. We're together for once a week for 10 weeks. So, we see a lot of different movements in the markets, which I think is important because things change on a weekly basis, and that's good experience for the trading. But I love to teach. I, I, I have taught absolute beginners all the way up to serious hedge fund managers and everywhere in between. I think I teach very valuable things, and it's very important to me that my students succeed. So, if you would like to become one of my students, I would love to have you. I'll teach you everything I know. My email is in the link of this YouTube video. Just send me an email and we could get the conversation started. The 20-hour course is $2,000. I know it's a lot of money, but really, I'm going to teach you a skill that you can use for the rest of your life. So if you're interested, please send me an email and we'll get the conversation started. Alternatively, in addition to the 20-hour one-on-one course, I have a really good online video course at udemy.com. And the link to that udemy.com course is in the link of the YouTube video. But that's a great video. I've had that out for many, many years. I have sold a lot of those all around the world. I teach you exactly the rules and the strategy of the deep dip buy stock trading strategy. It's 9.5 hours, and that video is priced somewhere between I think $30 and $50 most of the time. It's really great. I think I have 4.85 stars on that particular video. So anyway, either two choices for you: the one-on-one course, 10 hours a week for or 2 hours a week for 10 weeks, and then the online video course. So if either of those are interest to you, the links and my email are in the description. So anyway, thank you for letting me take a couple minutes, put in my plug, and let's get back to the potential trades for next week. So Amazon I like. Now, I don't know if it's going to come into play here, but let's go over Amazon. We did form a new order block here. Let's take a quick look. Why? Well, here's the swing low, followed by a swing high, followed by a lower swing low, and then this day here takes out the swing high. So swing low, swing high, lower swing low, market structure change. As soon as we have the market structure change, we can define the order block. The order block is the lowest closing bar prior to market structure change. The high and the low of this bar here on the 25th is the order block or the smart money area. So I bring it into the future. Now, I like when there are major moving averages living inside of the order block or the smart money area. So Here is the 250-day moving average at 231.77. The orange line is the 300-day moving average. So here are two key levels that I could key off of if the market does come back. As a matter of fact, even a rejection of the 200-day moving average would be valid because it's so close to the high of the order block. So next week, if we do pull back, and we may not, maybe Amazon just continues up here a little bit and we miss the trade. That's fine, happens all the time. But I do want to have this mapped out in case it does come down. So for right now, if Amazon does reject the 200-day moving average, I would consider that as an entry. If it moves lower, rejects the 250-day moving average, I would also consider that. And then, of course, the 300-day moving average down here would also be valid. And the bottom of the order block would also be valid. The bottom of the rejection, the bottom of the order block is always legit. But really, right now, I'm looking for a pullback to the rejection of the 200, the 250, or the 300-day moving average. The 200 is not in the order block. The 250 and the 300 are in the order block, but because the 200 is so close to the top of the order block, I would consider. So I'll watch Amazon carefully and we'll see what happens. FedEx. All right. I've talked about FedEx for a couple weeks here. I was talking about megaphone trend lines before. So megaphone trend lines, when you take a swing low and then you have a lower swing low beneath it and you connect the lines. Well, here's the first swing low. Here's the second swing low. If you connect those out, if you connect those two, then the trend line goes out into the future. And you can see here on the 24th, it did reject the trend line and it did reject the 200-day moving average. I didn't take the trade. It did start off good and then fail. But what I've noticed is, look, every time we've come down to the extension of that trend line, here we rejected it. We were below during the day. We closed back above. Here on the 30th, we were below it, closed back above. The next day, below it, closed back above. Thursday, below it, closed back above. So you can see at the moment, the market is respecting that megaphone trend line. So I don't generally enter just based upon a rejection of a trend line, but it does kind of call attention to the fact that it is rejecting this level. For me, really to want to get interested in getting into this trade, the rejection of the bottom of the trend line is important, but I would simply wait for a close back above the 200, and then I would use the 200 as my stop. So that's how I'm looking at it at the moment, and so we'll see what happens. IWM, which is the Russell 2000, we do have a previous order block here. And inside that order block, we have some key levels. We have the 50-day moving average, which is the gray line. So remember, with order blocks, an order block is a key level, but I like to have a key level within the order block. So in other words, a key level within a key level. So the 50-day moving average is one key level within the key level of the order block. I don't know if we're going to come down to here. We may not, but I want to have it marked up and ready if we do. Right now, that 50 is at 286.58. So I would be looking for a rejection of that 50-day moving average. In addition, I did place my own custom level in here, excuse me, at 284.30. Why did I put this custom level in? Well, if we come back here, we look at these two bars. This is a V1, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. On a V1 or a V2, halfway of the number 2 bar is inherent support. So that's exactly why I put the custom level in here at 284.30. So on IWM, a rejection of the 50-day moving average, 286.58 at the moment, but that will move. But the static level rejection level here is 284.30. Let's go to Meta. All right, so Meta had a huge move up. I almost took this trade here on the 30th. I wish I would have, obviously, but I didn't. But, let's kind of flesh out why I wanted to potentially take it. So earlier we talked about an abandoned baby. Abandoned baby consists of three bars. You gap down, followed by a gap up, a very sudden shift in sentiment. Here, highlighted in blue, is not an abandoned baby, but it is called an island reversal. An island reversal is similar to an abandoned baby, but abandoned baby has one bar where island reversal has two or more. So the key thing here is that from this day, the 24th to the 25th, we gapped down. We moved sideways for one day, and then we gap up, leaving these two bars kind of by themselves, like an archipelago, right? Like an island. So we gap down, one day sideways, gap up. When this happens, again, that's bearish to bullish very quickly. When this happens, I usually wait for a rejection of the high of the island reversal, which happened here, but I didn't take the trade. And it just took off like crazy because Meta had some news, right? And then it's come back down on Thursday quite a bit. But really, what I'm looking for, I don't know if it will do this, obviously, but I'm looking for a pullback and rejection of the high of that abandoned baby at approximately 557. Same thing that we did here on the 30th. I'm looking for that to happen again. May not happen, probably won't happen, but I could be wrong. I don't know. But I just want to have this marked up and ready because if it does come back to this level, there's a good chance there will be some buyers there because there were buyers there before. So just to recap, I'm looking for basically a rejection of 557 and a close back above it to potentially get long on Meta. NVDA, well, NVIDIA has not really been participating. The chip stocks have been weak, clearly weak. But at the moment, NVIDIA, we have this order block from the past. We have the 100-day moving average, which is the red line that lives inside the order block. Now, on Thursday, we closed below the order block. We closed below the 100-day moving average. So it lost those. But what I'm waiting for at the moment next week, if we close above the 100-day moving average, if we close above 196.81, I would consider getting into the trade with a close over the 100-day close over the 100-day moving average, and then my end of bar stop would be a close below the 100. And then last but not least is XLE. All right, so XLE is energy. Of course, energy has come way, way, way down after having a huge run up, but we are coming to a key area. We're coming to a key area that was once very smart money before it took off. Now we're coming back down to that smart money area again. And this one's pretty simple, everybody. 200-day moving average at the bottom of that order block, a key level within a key level. A 200 by itself is a key level, but the 200-day moving average living inside the order block and the bottom of the order block, even better. So energy would have to come down quite a bit next week for us to get there, but what I'm looking for is a rejection of that 200-day moving average. Right now it is at 51.34. The price is 53.22. But if we head down, we could certainly reject that. And if we do reject that, I think that's a good level. Doesn't mean it's going to work. But if it rejects the 200, I would potentially enter the trade. And then I would stay in the trade as long as it closes above the 200, and I would exit the trade with a close below the 200-day moving average. So that's what I have on tap for next week. That's what I'm going to be looking at and following. I hope you found today's podcast helpful. If you did, like I said, I would really appreciate it if you could hit the thumbs up button. If you have any comments or questions about anything that I discussed in the podcast today, just put them in the comment section. I'll do my very best to answer and reply. I always like to leave off, I have this small little platform, but I always like to leave off with, if you have the opportunity to help somebody any particular day, an act of kindness that that you can do for them, do it. They will appreciate it. It's good for you. They will appreciate you for doing it. It's just, you know, excuse me, it's just good karma. And I think this world could really use more of that, not a big thing, just one little thing each day that you potentially help somebody out with. Doesn't have to cost any money, just maybe a little of your time, a little of your effort. It would just make the world a much better place, and I think we need it. I'm also a very big animal lover, have been my whole life. If you have the opportunity to do one nice thing for an animal, if if you have that opportunity, do it. They appreciate acts of kindness just like we do, and we appreciate when someone helps us. So why not return the favor and help a person or help an animal if you have that opportunity? So I appreciate you being here. I hope you found it was helpful. If I can help you with anything, please let me know. I do teach the 20-hour one-on-one course. I have the online deep dip buy course available at udemy.com. I also do private consulting. If you need help with options or need help with anything, help a lot of people with a lot of things in trading. So I'd love to help you too. So just reach out to me. So thank you very much, everybody. I hope you have a nice weekend. Happy 4th of July to you. Hope you enjoy and be safe. And God willing, I will see you next week. All right. Thanks so much for your time. Appreciate your. We'll talk to you later. Bye-bye.
This video or live broadcast, instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.